Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of private placements: what they are, how they work, and why they matter. Attracting institutional investors. Private placements often appeal to institutional investors like hedge funds, pension funds, and insurance companies. Why? These investors are drawn to the exclusivity and strategic opportunities that private placements provide. For companies, this can mean stability. Institutional investors bring financial strength and long-term commitment. Strategic input. These investors often offer more than capital, they provide expertise and guidance. Scalability. Access to larger pools of capital enables companies to execute bigger plans. Engaging institutional investors through private placements often leads to strong partnerships that go beyond simple funding. It's a win-win for both sides. Businesses grow while investors gain unique opportunities. Risks and challenges of private placements. While private placements offer unique advantages, they also come with risks that both companies and investors must carefully consider. These challenges can impact liquidity, compliance, and even a company's reputation. Before jumping into a private placement deal, it's critical to understand these potential downsides. Liquidity risk. The challenge of selling privately placed securities. One of the biggest concerns in private placements is liquidity. Unlike publicly traded securities, which you can easily buy or sell on stock exchanges, privately placed securities are difficult to offload. Why? These investments often come with restrictions that limit when and how they can be sold. For instance, investors may face a lock-up period, where selling isn't allowed for a specific length of time. Even after that, finding a buyer for private securities can be tricky because there's no ready market for them. For investors, this means they must commit to holding onto the investment for an extended period. If they need quick cash or decide to exit, they may face obstacles or end up selling at a discount. It's similar to owning a custom-built home in a neighborhood without many buyers, valuable but harder to sell quickly compared to one in a hot real estate market. Companies offering these securities must be transparent about these limitations. Failing to address liquidity risks can frustrate investors and complicate future fundraising efforts. Regulatory compliance issues. Risks in navigating legal frameworks. Private placements might avoid the intense government scrutiny of public offerings, but they aren't free from compliance risks. They operate under exemptions, such as Regulation D in the United States, which comes with its own set of rules. Failure to comply with these regulations can lead to hefty fines, legal action, or a damaged reputation. Some potential pitfalls include misidentifying eligible investors. Regulations often specify that only accredited investors can participate in private placements. Companies must verify their investors' qualifications before proceeding. Inadequate disclosure. While the rules don't require public filings, companies must still provide accurate and sufficient information to investors. Misrepresentation, even unintentionally, can lead to lawsuits. Cross-border challenges. Raising money from international investors introduces additional complexities, as companies might need to adhere to regulations in multiple countries. For startups and small companies without legal expertise, navigating these rules can be overwhelming. It's like trying to sail a ship without a map. You'll either waste time correcting mistakes or risk crashing into compliance violations. Legal and financial advisors are often necessary to avoid these hazards. Market perception and reputation risks. Balancing opportunity with potential backlash. Private placements can be a double-edged sword when it comes to reputation. On one side, they offer exclusivity and a streamlined process. On the other, they can attract scrutiny if managed poorly. For instance, if a company approaches non-qualified investors or miscommunicates the terms of the offering, it can appear untrustworthy. Raising funds privately can also send mixed signals to the market. Stakeholders might wonder, why isn't this company pursuing public funding? Is something being hidden? Public perception matters even in exclusive financial dealings. A poorly executed private placement could alarm customers, employees, or future investors. Worse, negative experiences from one round of private fundraising can ripple into future rounds, limiting engagement from serious investors. Think of reputation as a glass vase, it's easier to shatter than repair. Companies must take extra care to maintain clear communication, meet investor expectations, and ensure transparency wherever possible. For investors, due diligence is key to spotting red flags before committing to a deal. The process of private placements. Executing a private placement involves several critical steps. Each stage requires careful planning and effective communication to ensure a successful outcome. Whether a business is raising its first round of private capital or managing subsequent funding efforts, understanding this process is essential. Let's break it down. Identifying target investors. Finding the right investors is the foundation of any successful private placement. Not every investor is a good match, so targeting the right individuals or institutions is key. But how do you identify them? Start by defining who you're looking for. Are you targeting institutional investors, like pension funds or banks? Or would high net worth individuals or family offices be a better fit? Knowing your ideal investor profile helps narrow the search. Here are some strategies to connect with suitable investors. Leverage existing networks. Use contacts within your industry or personal connections to get introductions. Warm leads are far more effective than cold pitches. Work with intermediaries. Engage brokers, investment banks, or advisors who specialize in private placements. They can connect you with investors already active in your sector. Attend industry events. Look for private placement-focused summits or investor conferences. These are prime opportunities to meet potential backers. Create a compelling pitch. Investors are busy. Tailor your pitch to highlight why your offering is a good fit for their portfolio. Screen for alignment. Beyond capital, ensure potential investors share your vision and long-term goals. Choosing the right investors isn't just about the money. A good match can bring strategic advice, mentorship, or connections that help your business grow. The wrong fit, on the other hand, can lead to misalignment and conflict. Valuation and due diligence. Getting the numbers right is crucial during a private placement. Valuation sets the stage for negotiations and determines how much equity or debt you're offering for the requested funds. At the same time, investors will conduct their own due diligence to validate your claims. Here's why valuation matters. Fairness. Overestimating can scare off investors, while underestimating dilutes your ownership unnecessarily. Clarity. A solid valuation builds trust and makes your offer more attractive. How do you establish a fair valuation? Often, businesses rely on financial projections, market analysis, and past performance to justify their numbers. Professional appraisers or advisors can also provide third-party expertise. On the flip side, expect investors to do their homework. Due diligence means they'll review financial statements, leadership team credentials, customer contracts, intellectual property, market potential. Be transparent and ready to answer tough questions. Investors want to know your business is stable, has growth potential, and offers a good return on investment. Think of it like preparing for a job interview. First impressions and honest answers can make or break the deal. Negotiating terms and conditions. The final stage of the private placement process is negotiating terms. This step defines the structure of the investment and sets expectations for both parties. It's a balancing act. You need terms that attract investors without compromising your company's long-term goals. Key considerations during negotiation include equity versus debt. If you're offering equity, how much ownership are you giving up? If it's debt, what repayment terms and interest rates will apply? Voting rights. Will investors have a say in business decisions? Some may require board seats or veto power over major actions. Exit strategy. Define how and when investors can sell their stake or recoup their funds. This could include IPO plans, buybacks, or mergers. Protective clauses. Investors often request safeguards like anti-dilution rights, liquidation preferences, or restrictive covenants. Be sure you understand these terms fully. Timelines. Ensure there's agreement on funding disbursements, reporting schedules, and other milestones. Approach negotiations with a clear understanding of what you are and aren't willing to compromise on. It's not just about what investors want, your company's future is at stake. Having legal and financial advisors in your corner can help ensure the final agreement is fair and aligns with your broader vision. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.